Hello, welcome to Fininvest Niger. My name is Tom Princefield. I'm a certified securities and investment specialist, and I've been investing for the past 2 decades. In the course of this presentation, I would like to carry out a fundamental analysis of this particular company, McNichols Consolidated Plc. McNichols Consolidated Plc. The company is into food processing and is listed in the agricultural sector of the Nigerian stock exchange. And so, without much ado, let us start with the company's revenue. So, the company, generated a revenue of 5.856 billion naira in the full year 2024. 5.856 billion naira as against 6.275 billion naira. 6.275 billion naira in the full year 2025, giving us a percentage increase of 6.8%. 6.8%. We now come down to the company's profit before tax. The figure here is 151.710 million as against 387.240 million naira, representing a whopping increase of about 155%. This is quite commendable. This is remarkable. All right, from 151.710 to 387.240 million. That's 155% increase in profit before tax. We now come to the profit after tax figure. The figure is also quite remarkable. It's awesome. That's 115.763 million as against 342.462 million naira. 342.462 million naira, giving us an increment of about 196%. 196% increment in the profit after tax. This is fantastic, actually. It's impressive. We now go to the company's total comprehensive income. That's for the year 2024, it's 115.074 million as against 307.338 million naira, giving us an increment of about 176%. Okay, we move down to the most important figure in our analysis here, the most important item in analysis, which is the earnings per share. The earnings per share determines the company's future price, and as well as determine the level of dividend the company could pay out. And so we discovered that in the year 2024, the earnings per share was 10 kobo, and then in the full year 2025, the earnings per share grew to 27 kobo. This is fantastic. It more than doubled. It's more than doubled, giving us a percentage increase of 170%. 170% is the increase in earning per share for this particular company. The entire, the entire fact, the entire figures there, are really, are impressive. Now we want to look at the company share price. The current share price is 8 naira 90 kobo. All right, 8 naira 90 kobo as against 1 naira 43 kobo last year, 2024. Okay, representing an increment of 522%. 522%. So in a kind of layman's language, in a language we could very easily understand, if you had invested 1.43 million naira in this company in the year 2024, that investment will yield 8.9 million naira. Okay, 1.43 million naira will yield 8.90 million naira. That is the kind of increase you will have, in this particular company. Okay, so it's quite impressive. Actually, I'm somewhat impressed with this particular company. So we are through with the profit and loss segment of this particular analysis. We want to look into the company's balance sheet, as well as the cash flow statements, which is represented, on the other side of the table. So let's come to this side of the table. The company has a share outstanding of 112, okay, 1.12 billion. 1.12 billion is the number of shares outstanding, and then there is a market capitalization of 9.94 billion. 9.94 billion. This is the number of shares the company has outstanding. And then the company's equity here is also known as shareholder fund. It's telling us about the difference between the company's total assets minus its total liabilities. That will give you 926.166 million naira. 926.166 million naira. So the company has a positive equity, and it has a strong balance sheet of almost a billion naira. So we now come to the company's equity per share. In other words, you divide the equity by the shares outstanding. That will give you 83 kobo. So this particular value is what is called the book value of the company. And the book value of the company on its own may not really tell us much, may not really give us much insight into the company. What happens is that you compare this value with the company's recent share price. So if you subtract 8 minus 8 naira 90 kobo minus 83 kobo, you discover that there could be a kind of wide difference. Okay, so it tells you that the company actually is not all that cheap, but it's moderately okay. All right, generally, the difference between this and that will determine how cheap the company is. If it's actually very wide, the company could be somewhat expensive. If it's somewhat a little bit narrow, the company is considered to be cheap. Okay, and so in this particular case, the company isn't all that cheap, actually, to be very precise. And not only that, you discover that the company has a cash balance of 409.98 million. 409.98 million is the company's cash balance here. 409.98 billion naira. So the company has a robust balance sheet, a robust cash position, cash at hand, cash in the bank, and cash equivalents amounting to this particular figure. So both the cash flow statements and the company's balance sheet is quite very strong. It's relatively strong. All right. So we now move down to the company's PE ratio here. That's the price earning ratio, which represents the company's price 8 naira 90 kobo divided by his earnings per share. When you divide these two figures, you are going to get 32.96. And what's the meaning of this? It's telling you how expensive or cheap the company is. In other words, it's telling you that you are buying a naira of this company's earning, a naira of the company's earning for 32 naira 96 kobo. It's like going to a shop to buy an item worth 1 naira for 32 kobo, for 32 naira 96 kobo. That's the idea of the PE ratio here. And of course, we make comparison between this and other companies in the same sector. Okumu is there in the same sector. Presco is there. This is the agricultural sector. LLX is there. They are all in the same sector. You make comparison between this company and companies in the same sector. Now, let's go to the final aspect of our analysis here. Can I buy this company, or should you buy this company? Personally, this company is doing very well. You could see the increments, down here, particularly the increment in earnings per share, about 170% increase in earnings per share. And this PE ratio, though high, is tolerable. Okay, it's tolerable. So you could make it a tiny portion of your portfolio, not more than 5% of your portfolio is okay for McNichols Consolidated Plc. And I would like to actually emphasize the fact that I've discovered that from my interaction with clients that a vast majority of the portfolio out there are not optimized for increase in returns on investment. People's portfolio are generally in a pathetic condition because of lack of inability to actually choose the right stock. People just buy stocks and then are not really doing well in their investment journey because of a lack of guidance, a lack of support and kind of advice, recommendation from people that are somewhat, kind of knowledgeable. So please, if you want me to come in and see how I can work with you to optimize your portfolio, to recommend, great stocks for you, to be able to, increase your return on investments, along the way, please, you could contact me here and let's see how we can work together. I will use my little wealth of knowledge to see how I can benefit you in your wealth creation journey. Please contact me and then we can work together, in that regards. And not only that, please like this video and subscribe to this channel. Share this video as well, okay? And don't forget to drop a comment in the comment section. Any company you want me to analyze for you, please let me know in the comment section and I'll try my best to make sure that I analyze the company for you. I'm very grateful for watching. Thank you very much and continue watching even other videos in my channel as well.